This content is for educational purposes only and is not financial advice. Investing involves risk. Do your own research and consult a professional before investing. Hi everyone, welcome back to my channel. In the Canadian income investing market, there has always been a very distinctive and fairly aggressive category of products: split share funds. In particular, the Class A shares of split share funds can offer strong share price upside, while many of them also pay high cash distributions. Over the past few years, some split share Class A shares have delivered very strong performance, in some cases clearly outperforming both the S&P 500 and Canada's TSX 60 market. Today we are looking at CLSA, Brompton's all-in-one ETF for split share Class A exposure. It packages a basket of Class A shares into one ETF, combining high distribution characteristics with strong growth potential. So today, let's look at what CLSA actually owns, why it has performed so strongly, and what kind of income investor it may be suitable for. Before we dive into the heart of the video, I want to take a moment to talk about Moomoo Financial Canada. One feature that really stands out, especially for income investors, is that they are currently offering 0% currency conversion fees between CAD and USD. As many of you know, some of the strongest income-generating products are only available in the US. It allows you to convert your distributions much more efficiently. Secondly, for those who crave a sense of control over their portfolio, the detailed ETF data on Moomoo is excellent. Having that data organized like a digital pay stub is a massive time saver. If you're looking for a more efficient way to manage your income portfolio, Moomoo is definitely a choice worth looking into. Let's start with the basics. CLSA.TO is the Brompton Split Corporation Enhanced Equity Income ETF. The issuer and portfolio manager are both Brompton Funds Limited. It trades on the Toronto Stock Exchange and is denominated in Canadian dollars. According to the official page, it is actively managed. Its inception date is March 20th, 2025, and its official risk rating is high. On June 19th, 2026, the official page showed a closing price of 17.79 Canadian dollars. The NAV on June 18th, 2026 was 17.62 Canadian dollars. For income investors, the most direct attraction of CLSA is the monthly distribution. It currently pays 0.18 Canadian dollars per month, and the official distribution rate is 12.14%. That is usually the first number people notice. But when we see a distribution rate around 12%, we should not stop at the words high yield. For any high distribution product, we need to ask where the cash flow comes from. CLSA is not mainly about ordinary stock dividends, and it is not a covered call ETF. Its core exposure comes from split share Class A shares. Understanding that structure is the key to understanding this ETF. We previously made a dedicated video about split share funds, so let's do a quick review here. A split share fund usually holds a basket of dividend-paying stocks and then splits the structure into preferred shares and Class A shares. Preferred shares are more fixed income-like and receive distributions first. Class A shares can be understood as using the capital contributed by the preferred shares to invest alongside their own capital, so they take on more complete exposure to the gains and losses of the underlying assets. In simple terms, the core idea of Class A shares is to use this structural leverage to amplify the upside and cash flow characteristics of the underlying stocks. That is why we should not simply say split share funds are bad. They are not designed for everyone, but they do serve a very clear type of investor. Someone willing to accept higher volatility in exchange for higher cash flow and stronger equity upside. As long as investors understand the structure, the drawdowns, and the possibility of distribution changes, these products can have a place in an income portfolio. This relationship is worth making clear. CLSA itself is an ETF managed by Brompton, but the ETF does not directly buy a basket of ordinary stocks. It invests in a basket of Class A shares issued by Canadian split share corporations. Brompton states that CLSA seeks to provide attractive monthly distributions and the opportunity for capital appreciation through an actively managed portfolio of these split corporation Class A shares. Some of the underlying split share products are managed by Brompton, while others come from different issuers. In other words, CLSA packages a basket of split share Class A shares into one ETF, giving investors more diversified access to the split share Class A structure through a single ticker. Now let's look at the holdings. LBS at 14.9%, mainly Canadian banks and insurance companies. DFN at 14.5% and FDN at 12.6%, mainly Canadian financials and dividend stocks. SBC at 14%, Brompton's own Canadian bank split share. ENS at 12%, centered around Enbridge and energy infrastructure exposure. FFN at 10.3%, North American financials. LCS at 8.9%, Canadian life insurance companies, GDV at 4.4%, global dividend growth stocks, and PWI at 3.1%, power and infrastructure. Smaller positions include DF at 2.5%, IS at 1.9%, and DGS at 1.1%. Seen this way, CLSA is not a brand new concept. It is a basket of split share Class A products that have already existed in the Canadian market for a long time. Many of these underlying products are not new. LBS, DFN, FDN, SBC, and similar split share products are tied to mature assets such as Canadian banks, insurers, financials, and dividend-paying stocks. Some of these structures and strategies have been operating in Canada for many years. CLSA as an ETF has a short history, but the underlying asset class is not new. It takes a group of long-running split share Class A shares and packages them into a more convenient, more diversified, and easier-to-manage ETF. Brompton's fund profile also provides the overall sector allocation. Under that breakdown, CLSA is roughly 24.7% Canadian banks, 23% North American financials, 16.7% Canadian dividend equities, 15.8% Canadian leafcos, 15.3% energy and infrastructure, and 4.4% global dividend equities. In other words, financial and financial-like assets are the core. Banks, insurers, dividend stocks, energy, and infrastructure make up the main underlying exposure. If we combine Canadian banks, North American financials, and Canadian leafcos, CLSA's financial-related exposure is about 63.5%. So although this ETF is presented as an all-in-one split share Class A product, its main driver is still largely Canadian and North American financials. For income investors who are positive on the long-term performance of Canadian banks, insurers, and financial assets, that is part of the appeal. But if the financial sector comes under pressure, CLSA's volatility can also become very noticeable. From an income investor's perspective, this portfolio is easy to understand. It is not chasing hot technology stocks or short-term themes. It is concentrated in Canadian financials, banks, life insurers, dividend stocks, energy, and infrastructure. Canadian banks and insurers have long been an important part of Canada's dividend culture. They are mature, regulated, and have long dividend histories. Energy and infrastructure can be more cyclical, but they also tend to have cash flow characteristics. Of course, concentration also means risk. If financials and dividend assets face sharp interest rate changes, a weaker credit environment, or a pullback in the financial sector, CLSA will be affected. Class A shares are already more volatile than ordinary stock portfolios. That risk should not be downplayed. But from an income investor's perspective, risk does not automatically mean a product is bad. It means position sizing matters. It means you need to know why you own it. It also means you should not treat it as a cash substitute. Next, let's talk about fees. The official fund profile shows a management fee of 0.6% per year. For an actively managed income ETF, that management fee itself is not unreasonable. But the ETF facts document shows a management expense ratio, or MER, of 10.71%, a trading expense ratio of 0.18%, and total ETF expenses of 10.89%. That MER looks high, so it needs to be explained clearly. For a normal ETF, the MER usually means management fees plus operating expenses, so it is easy to compare across funds. But split share Class A shares have a different regulatory expense reporting structure. Because the distributions paid to preferred shareholders are reflected in the MER of the Class A shares, the number can appear very high. In other words, CLSA's 10.71% MER does not simply mean the manager is taking a 10% management fee. It reflects the regulatory reporting of the underlying split share structure. Brompton also published an explainer called Understanding Split Share MER. It explains that split share Class A shares can provide enhanced growth potential because split share funds also issue preferred shares. Preferred shareholders give up capital appreciation in exchange for fixed distributions, while Class A shareholders receive extra dividends and stronger upside potential. Regulatory rules require preferred share dividends to be included as part of the Class A share MER. Brompton's view is that, for Class A shares, performance after all fees and expenses may provide a more complete picture of what investors actually receive than the regulatory MER alone. What ultimately matters is whether, after all costs, it can provide meaningful cash flow, maintain NAV, and create long-term returns through underlying asset growth and structural leverage. Now let's look at performance. For comparison, I used two benchmarks. The first is XIU. It tracks Canada's TSX 60 index, which represents large-cap Canadian stocks. The second is VFV, which gives Canadian investors exposure to the S&P 500. The comparison is based on total return, so distributions are reinvested. CLSA is still a new ETF. It launched in March 2025, so the available performance period is short, from March 21st, 2025 to June 19th, 2026. That is about 1 year and 3 months. Over this period, CLSA delivered a total return of 108.11%, compared with 40.52% for XIU and 31.89% for VFV. That is a very strong result. It is not just a small outperformance. CLSA clearly outperformed both benchmarks over this period. From an income investor's perspective, this is not surprising. After CLSA launched, the environment was favorable for Canadian financials, banks, insurers, and dividend assets. Split share Class A shares have amplified upside in rising markets. Monthly distributions reinvested into the total return calculation also helped. In other words, CLSA performed well in an environment that suited its product design. Of course, we should not assume that one strong year means the same thing will continue forever. That reminder is necessary. But I do not want to frame this as the history is too short, so it is not worth looking at. A better way to say it is this. CLSA's public history as an ETF is short, but the split share Class A shares and strategies it holds have existed in Canada for a long time. The long-term performance of many of those underlying products comes from structural leverage and rising underlying equity assets. That is the more useful way to evaluate CLSA. For investors willing to accept volatility in pursuit of higher cash flow and stronger equity upside, CLSA is worth studying. For income investors, CLSA has several advantages. First, it provides monthly cash flow and an attractive distribution rate. Second, through the ETF wrapper, it packages a basket of split share Class A shares, making it more diversified than buying one individual split share fund. If the NAV of an individual split share Class A share falls too low, its distribution may be suspended. An all-in-one product like CLSA, which holds multiple underlying Class A shares, can help reduce the impact of one individual product suspending distributions on the overall cash flow. Third, it is actively managed by Brompton, so the manager can adjust the underlying holdings as market conditions change. Fourth, the underlying assets are not a brand new idea. They are based on split share structures and dividend assets that have been operating in Canada for many years. The risks are also clear. First, Class A shares are volatile, and drawdowns can be significant when markets fall. This is not an exaggeration. LBS, one of CLSA's important underlying holdings, has had a historical max drawdown of -86.77%. So during a black swan event or a severe financial market sell-off, Class A share prices can fall dramatically. Investors should be mentally prepared for the possibility that prices could fall by a large amount, even close to 90% in extreme cases. Second, distributions are not guaranteed and may change in the future. Third, NAV matters. If high distributions exceed what the underlying assets can sustainably support over time, NAV can be eroded. Fourth, although split share MER has a regulatory explanation, the structure itself is not low cost. In a bear market, Class A shareholders are not only exposed to falling underlying stock prices, but also to the pressure that high distributions place on NAV. At the same time, the fixed distributions paid to preferred shareholders are effectively an ongoing financing cost. In rising markets, this structure can amplify Class A performance. But in a falling or sideways market that lasts too long, falling prices, NAV pressure, and financing costs can all drag on returns. Fifth, the financial and dividend asset concentration is high, so a difficult environment for those sectors will affect CLSA. But these risks do not automatically mean CLSA is bad. A more reasonable conclusion is that CLSA is an income ETF that requires investors to understand the structure, control position size, and monitor it over time. It is not suitable for someone who does not want to study the product at all, and it should not be treated like cash or a GIC. But for investors who can accept equity volatility, care about monthly cash flow, believe in the long-term value of Canadian financial and dividend assets, and understand the split share leverage structure, CLSA is a product worth serious research. So CLSA does not have to be understood only as a high-risk, high-yield ETF. It can also be viewed as a portfolio tool. The advantage of Class A shares is that they use relatively low-cost preferred share capital to control more underlying assets. If an investor held half CLSA and half something like SPLT, an all-in-one split preferred share ETF, the combined structure would behave more like the underlying assets themselves. But we can also think differently. Instead of putting the other half into preferred shares, an investor could hold cash, ZMMK, or similar cash and money market ETFs. Then the portfolio becomes one side high upside Class A exposure, and one side cash and liquidity. This does not remove the risk, because the CLSA portion still carries the full volatility of Class A exposure. But it is not the same risk as being fully invested in the underlying assets. Having cash during a black swan event often means having the opportunity to rebalance or buy when prices are depressed. My view is this: many high-yield ETFs achieve high distributions through very concentrated portfolios, sometimes holding only 10 or 20 stocks. Those products may look attractive from a distribution perspective, but structurally they may be fragile because the underlying breadth is limited. CLSA is different. Its underlying breadth is better because it holds a basket of split-share Class A shares, with exposure to banks, insurers, financials, energy, infrastructure, and dividend stocks. Its real risk is not that the holdings are too narrow. Its real risk is that it uses a high-leverage structure to amplify capital growth and high distributions. So when looking at CLSA, the key is not simply to say whether it is good or bad. The key is to understand that it is an income tool with decent breadth but an aggressive structure, suitable for investors who are willing to understand leverage, accept volatility, and care about cash flow. If you found this video helpful, please give it a like, subscribe to the channel, and I'll see you in the next one.